Well, folks, it's that time of the week again. Welcome back to another edition of TA Thursday. So we are seeing a massive number of VIX call options. For those of you that are beginners, the VIX is the volatility index that measures how traders are expecting the market's volatility to behave in the coming days. So we have the most number of VIX call options since March 2020, since the start of the pandemic. Now, does this mean that the stock market is going to tank from here? I will get into this. We'll also talk about how resilient the labor market is and why that is putting pressure on the Fed to likely keep rates higher for longer. Terrible news as it relates to inflation coming out of Europe. Will we see a similar situation here? This is the number one fear of economists and the Fed, is that we get inflation creeping back up or sticking around. And this is why you see bond yields surging. We have the 2-year at 4.9, the 10-year back above 4. What does this mean for the S&P 500 that is now back in the neckline of the inverse head and shoulders, which is a very bearish failure pattern? And towards the end of the video, I will give you my trades and what I'm looking at upcoming. So you definitely want to stick around till the end for that bonus. We shorted Tesla right before Investor Day. We are up 40% on that short, because we typically tend to see sell the news events on Tesla Investor Day, Tesla Battery Day. We have a short on QuantumScape that's up 12% currently. And we had a monster day trade on NQ futures yesterday, almost 100 points, not quite there, but $1,980 per contract. I will go over this trade in a separate video. If you guys want me to highlight my trades in separate videos, let me know. I tend to do macroeconomic videos like this one. But if you want to see more trade recaps on this channel, videos dedicated to just trade recaps, leave it in the comment section below, and I will definitely do them if you guys get value out of them. And if you guys want access to all of our trades, all of our analysis, long-term, short-term, day trades, options, futures, nobody has the array of analysis and trades like we do. We trade literally every single instrument except for Forex. But sign up, link is in the description below. You definitely want to apply. And if you are approved, we will email you and let you know. Without further ado, let's get right into it. So what is moving the markets currently? Well, as I said, we are seeing a massive number of VIX call options, the most since March 2020. However, here's why I think these numbers are a bit skewed. If we take a look in detail, what happened to the price action on the S&P 500? I've gone over this in previous videos, but we saw massive amounts of buying near the top of this rally here. This rally since October 2022 was unexpected for most people, how violent this rally was. And the S&P 500 got to around the 4,200 level. We also saw a bunch of risk on stocks like ARK, Lucid, DocuSign, etc., just run up 100%. So what is fueling this is a combination of things. We have obviously short squeezes, and then we have FOMO retail buyers, but then also we have reports of institutions having to FOMO buy and put money to work for their investors that they've been sitting on the sidelines with. A lot of fund managers have been sitting on the sidelines with cash, expecting this to get much worse, not expecting stocks to rally 50, 60, 100%. And so they had to FOMO buy near the top and put their investors' cash to work. However, with that comes the necessity to hedge, right? It's obviously much easier to buy the dip. Well, much easier said than done from a mentality standpoint, but from a strategy standpoint, it's a lot easier to buy on the way down. However, a lot of fund managers were caught with their pants down, and now we're forced to buy at the highs. So of course, with that comes the necessity for hedging. So that is what I think is driving some of this. I'm not saying that we're not going to see major volatility upcoming. Obviously, there are a lot of factors that go into why a lot of traders and investors, institutions, etc., are hedging a lot with the VIX now. It has more to do with just FOMO buying. It also has a lot to do with the data drops that we're getting. So not only has inflation gone up much more than expected, we've had 4 of the last 5 inflation reports, CPI and PCE, coming in higher than expected. But also we are seeing labor market stronger than ever. The US labor market, if you look at the data, is super resilient as it relates to jobless claims and as it relates to wage growth. We're seeing an enormous amount of wage growth. So today, as of the time of this recording, the market expected 197,000 jobless claims. We got much less than that. But if you take a look at the labor costs, it was expected to rise by 1.4%. We got more than double 3.2% increase in labor costs for Q4. This obviously is now pushing the possibility of a 50 basis point rate hike at over 30%. Just yesterday, it was 29. Before that, it was 27. Just a month ago, it was 0% chance that the Fed would do a 50 basis point rate hike. And also a month ago, there was a 17% chance that the Fed would do no rate hikes, meaning they would pause. And now that is currently at 0%. Sorry, you may not be able to see that 17%, but it's there, I promise. We are also seeing still a major dislocation in yields. This, I think, is the longest period of an inverted yield curve that we've ever seen. So the 10-year, 2-year inverted yield curve has been inverted since July 2022 consistently. And for the 10-year 3-month that's been inverted since October 2022, this is the longest and steepest yield curve inversion that we've ever seen between the 10-year 2-year and 10-year 3-month. Now, a lot of you familiar with this channel know that I did a video talking about I sold my shares. I think this was on February 6th or 7th. So far, we literally sold the top. But there's a reason that I did this. It wasn't because I'm Nostradamus and I knew that this would be the top. I was taking a look at a number of factors. One is the inflation data coming in much higher than expected. And two is the equity risk premium. I've talked about this before, but the S&P 500 right now is in the what we call the death zone, meaning that you are taking on a lot of risk by investing in the S&P 500 here. Because of the S&P earnings yield, we're only getting about 4% on the S&P earnings yield. A real yield, if you compare it to the current CPI, is actually -3. But this is basically the totality of S&P 500 earnings over the totality of S&P 500 stock prices. We're getting a earnings yield of 4. And I promise I'm going to get to the TA in a second, but when you compare that with the yields that you're getting on a risk-free asset, like a US Treasury, these are zero risk, right? They are guaranteed assets, guaranteed by the US government. Really, anything 1 month all the way out to, every single yield actually, from the 1 month to the 30-year, 1 month, 2 month, 3 month, 4 month, 6 month, 1 year, 2 year, 3 year, etc., all the way up to 30 years, you were getting a better yield risk-free than what the S&P 500 is giving at current prices. And if we look at a measure of stock price strength, this is the extreme greed. This is really a measure of when we tend to see market tops. And right around where I sold was the top of this extreme greed. You could see that, when this thing hits a low, meaning when there's extreme fear, that is when we tend to see market bottoms, as we did in October, as we did last year as well, right before the summertime. And if you look at the safe haven demand graph, this is the difference between 20-day stock returns and bond returns. We're still in the greed section. And again, when this tops out, this tends to signify market tops. And when we're in a in a fear category, that tends to signify market bottoms, again, as we did back in October. And with the revised higher inflation here in the US, we are seeing sort of a canary in the coal mine potentially with Europe, as Europe's inflation is now ticking back up once again in Germany, in France, and other economic zones in Europe. And if we take a look at the Fed funds futures, we could see that institutions are betting that rates will peak in October 2023 at around 5.45%. And if we see a slight cut at all this year, it will likely happen in December. So if we tie it all back to the chart, where do I see the S&P 500 going? Do I see doom and gloom here like a lot of people are projecting, like the VIX is currently projecting? Well, if you look at when I bought stocks, the reason that I bought in October is because we achieved a 0.5 retracement on the Fibonacci from the bull market that we saw that started in March 2020. This was exactly the 0.5 point. And historically, this is usually the area where you want to start investing in a bear market, or at least where the most lucrative opportunities are. Now, I didn't think we would rise this heavily, seeing, 100% gain in some stocks such as Tesla. But when I looked at the reason that we gained, it was really due to irrational buying based on a fantasy that we will see a soft landing. So, do I think we will see a soft landing? No, we've never achieved a soft landing. I do think that because of things such as labor growth or wage growth, such as a strong labor market, that the Fed is really going to have to keep rates higher for longer. And one thing that I don't do is I don't fight the Fed, right? I think that the stock market had dislocated from the bond market towards the beginning of this year, where the bond market was like, hey guys, we are trading as if the Fed is going to pump rates higher and keep them there and try to crack the economy to have to get these prices to fall. Whereas the stock market was like, woo, party time, right? The stock market is one of the worst predictors of economic environments, of upcoming economic environments. The bond market is one of the best predictors of upcoming economic environments. And as I said, from a technical perspective, we had this inverse head and shoulders. We broke out of this inverse head and shoulders here, but we didn't break out significantly. We consolidated. This was right around the time of the FOMC meeting. We consolidated a bit. Inflation did come in surprisingly higher, and we started seeing the effects of that with the stock market now following suit with the bond market, believing the Fed a little bit. And since then, we have seen a pretty significant drop in the stock market within the last couple of weeks. The stock market is down almost 6%. Now, we do have upcoming data drops. Remember, March 14th, we have CPI, and March 22nd, we have the Fed meeting. If CPI comes in higher than expected, as we are seeing in Germany, as we are seeing in France, and as we can potentially see in the US. I mean, anecdotally, if you talk to people, people will tell you, I don't know where these price drops are occurring. My rent is going up, my groceries are going up, gas is still relatively high, near $5 a gallon, depending on where you live. I'm not sure where in God's name these prices are dropping. So if March 14th CPI ticks higher, I definitely think we are on track to revisit the October lows. And this is what I don't understand with the perma bull thesis here, right? I'm not a bull, I'm not a bear, I'm just realistic. I was a bull, I guess, by definition in October, because from a technical standpoint, I was okay buying at the 0.5 retracement of the previous bull market. But in this case, when I look at the reasons for this rally, they all seem to be fantastical, right? And they don't follow what the bond market is trying to tell the economy and trying to tell investors. So I don't understand being a major bull when this rally will really can only really survive if the data drops are there to support it. If the data drops are not there to support it, then unfortunately, I don't think this rally can sustain itself, because there's nothing else to rally off of, right? Liquidity is trying to be taken out of the market. That's what rate hikes are designed to do. That's what rolling off of treasuries are designed to do. And I want you to take a look at this trend, right? Now that I'm just looking at this, I'm drawing it out roughly. If you take a look at this trend, I bet you if we pull up something like the MACD, let me see. Now, I don't use the MACD for trading, but I do use it for, broad stroke fundamental analysis, right? Even though it's a technical indicator, but I do use it for a broad stroke take on the market, but I don't use it for like day trades. But once we get these violent rallies and the S&P 500 breaks that violent uptrend with a MACD that's crossing like this, you saw this back in April 2022, you saw this in August 2022, you saw this in December 2022 leading into January, and you see it now, right? This tends to lead every single time since this market, since the post-pandemic market, this has led to lower lows. And again, for me, in conjunction with the data drop that we're about to get, if inflation is ticking higher, I definitely think we're going to revisit October lows. Now, if inflation miraculously is significantly lower, then I think that we could, retest this area here that we've seen. Sorry, let me make this smaller and show you what I'm talking about. Retest this area. This is clearly a demand zone, right? Where we've seen the S&P 500 hit. So really I would say between 3,700 and 3,900, we could stop there, right? Like if inflation is significantly lower, I do think that the market will likely stop in this zone and rally higher. So for me, it's really dependent on the upcoming data drops, but the bond market is definitely signaling it has really surrendered to the Fed, and the bond market is signaling, hey, we believe you. Please don't hurt us. So in terms of trades, let's go over that. And again, leave it in the comment section below if you guys want dedicated trade recaps where I'll take you through every step of the way of why I made a trade. We'll go through the chart. We'll go through the strategies that I'm using. We'll go through my stop limits, the risk to reward, how much money I made, etc. If you guys are interested in those kinds of trade recaps, dedicated videos for them, I will do them for you if you find them helpful. So yesterday we had a trade on NQ, which I definitely want to recap because this was a 100-point trade on the NQ, which are the NASDAQ futures. But we took it after this liquidity grab here. You could see these wicks here. And if you're a fan of this channel, you know that I talk about why these stop limits happen, why these wicks happen. But we took it from this liquidity grab zone and rode it all the way down to near this sell side liquidity here, right? And we closed our position here for 99 points on the NASDAQ, which equates to almost $2,000 a contract. We also sold a call spread on Tesla for Investor Day. The reason that I did this, and Tesla fans will get butthurt, but this is just being objective. This is not anything against Tesla or what they had presented. Short of releasing the Model 2 on Investor Day or announcing the Model 2. These are usually sell the news events because the suckers buy into the rally pre the event, thinking that for some reason the event will make the stock rally, right? These are not like earnings, where earnings, you get bottom line, top line numbers that are showcased on the earnings call. In this case, Tesla, Battery Day, Investor Day are usually sell the news events. So we had a short call spread that's up 40%. We still have that open. For those of you, again, that are fans of this channel, we had the Meta short that we took from here. We closed half of the position at our target, which was the 0.5 fib level of 167. And then I closed the rest at near break even. So only took half a position profit on this. And then we currently have our active QuantumScape short, which is going extremely well. This one is up 12%. This one to me was a very, very easy tag. I look for these earnings overreactions. Then we had this inside bar right after this 32% bullshit rally for no reason. This inside bar happened to coincide with the golden pocket on the Fibonacci. Took this short. We're up 12% on this. And I just shorted the shares here. I didn't buy puts because the IV was too high. And I was happy shorting the shares. It's a relatively cheap stock. It was at around $10 when we shorted it. And currently I'm in a ZT futures trade, which is currently down, actually almost hit our stop limit. This one I'm going to stay in. I'm longing the 2-year futures here. It could be premature. I did indicate that this was a little bit risky to front run this right before the CPI data coming out on March 14th and the Fed meeting on March 22nd. So the reasoning behind this is that we're expecting the 2-year future, the 2-year yield to finally hit a roadblock. And when the 2-year yield starts dropping, these futures go up. However, if inflation comes higher than expected, the 2-year yield will likely continue to make new highs. If we take a look at the 2-year yield now, this is basically when I longed the 2-year futures based on the fact that we could see some resistance here. But if inflation comes in higher than expected, this 2-year yield is going to shoot through the roof. So that trade will actually lose and get stopped out. But it was a 2-to-1 RR, meaning we are risking 1 to make 2. So I'm okay with that. As long as the RR is good, I'm going to hold on to that trade until we either get stopped out or are in profit. We'll see what happens here on the 2-year yield. Anyway, that is it for this video. Hope you enjoyed this segment of TA Thursday. Let me know in the comment section if you want me to do trade recaps. We'll be happy to do that. If you want access to all of our trades and analysis, the live chat, we're there 24/7, pre-market, post-market, etc. Apply in the link down below. If you are approved, you will know. And if you are approved, then I will tell you, welcome to the Academy. You get access to over 60 plus course videos as well. You get access to the Zoom calls with me. We will likely do one next weekend. You definitely don't want to miss those masterminds. We go over a ton of info on there. They are some of the best learning experiences, in my opinion. You will not find a trading group more comprehensive than this that trades options, futures, day trades, long-term, short stocks, etc. Hit that thumbs up, subscribe to the channel, turn those notifications on. Stay safe out there, traders. Peace.